Welcome back to Smart Stock Sam, and today we're discussing Rezolve AI, a company caught in a violent tug-of-war between the massive ambition of agentic commerce and the crushing gravity of a distressed balance sheet. We're breaking down whether this new major acquisition will bring profit, or if it's the final nail in the coffin. Analysts are calling this a spring-loaded technical setup, but for investors, it's a high-stakes game of chicken. By the end of this video, you'll know exactly what thresholds to watch. But to understand why the stakes are so high, we have to look at the massive gap between the promise and the current reality. On one hand, Rezolve is pivoting toward a $176 billion retail media market, aiming to integrate $90 million in new revenue through their latest acquisition. But here's the reality check. They are burning cash with negative working capital of nearly $45 million, and the stock has plummeted over 70% in the last 3 years. We are seeing a classic underwater institutional cohort because the current price is 35% below their recent financing round. Can this acquisition really turn the tide, or is it too little, too late? And that financing level has created a massive technical barrier that the AI narrative simply hasn't been able to break. Look at this overhead supply gap. Since January, the stock has been trapped below the $4 mark like it's stuck in quicksand. Every time it tries to rally, those private placement participants who bought in at $4 are likely looking for the exit, creating massive selling pressure. Even a recent 7-day bounce wasn't enough to decouple the stock from its financial distress. Is this a permanent ceiling, or are we about to witness a breakout that catches everyone off guard? However, if you think the bears have complete control, you need to see the hidden data that the official reports are missing. This is where things get absolutely volatile. Official Nasdaq reporting shows a manageable 16% short interest, but real-time estimates suggest the actual short position is double that, over 30% of the float. And get this. Nearly 43% of volume is hidden in dark pools. We are looking at a spring-loaded backdrop that could explode in either direction. Any positive catalyst could trigger a violent short squeeze that sends this stock parabolic, but any bad news will accelerate the downward spiral. Could we see a 100% move in a single day? And the options market is already placing its bets on exactly where that explosion or collapse will happen. There is a psychological ceiling at exactly $4. Look at the heavy call open interest right at that financing level. Traders are essentially betting that until that $4 wall is breached, the short sellers remain in total control of the tape. If the stock can't break through, it risks becoming a liquidity trap where every rally gets sold into resistance. So, what is the prize that makes investors willing to fight through this much resistance? It's all about the network. Rezolve is trying to bridge agentic commerce, AI that actually completes transactions, with the global payment rails of Visa, Mastercard, and Amex. We're talking about immediate access to 100 million cardholders and major banks like Barclays and NatWest. The goal is to use this loyalty revenue to offset the massive burn from their AI development. On paper, this is brilliant synergy. But it sounds like a perfect synergy until you dig deeper into how they paid for this bridge, and the story gets complicated. This is a semantic sleight of hand. Management called the reward loyalty deal non-dilutive because no new shares were issued directly to the seller. But look at the math. The $230 million in cash used for the purchase came from a January offering that expanded the float by 62 million shares. Even after spending that cash, the company is still left with a $44 million working capital crisis. Is this financial engineering brilliance or financial desperation disguised as strategy? And the financial pressure doesn't stop with the purchase price. It's about the Herculean effort required to actually run this new machine. Rezolve is attempting an unprecedented scale-up. They are trying to jump from $5 million in trailing revenue to $90 million. That is a 1,600% expansion gap. Merging a lean AI development shop with a mature loyalty platform creates massive cultural and operational risks. If they can't achieve immediate monthly profitability, the EBITDA pressure will be unsustainable. Have we ever seen a company successfully execute this kind of impossible vertical leap without crashing? Now, none of this matters if the market doesn't trust the people at the top, and there is one major governance red flag we have to address. We have to talk about the Wagner Factor. CEO Dan Wagner served as a director at Reward Loyalty, the company Rezolve just bought, right up until the month before the deal. This creates a conflict zone that the market is currently pricing in as a massive discount. Investors are demanding full transparency on whether Wagner personally benefited from this transaction before they'll give the stock a fair valuation. So, with all these risks, why are some of the biggest names on Wall Street still pointing to the moon? The disconnect here is staggering. While the stock is languishing at $2.59, analysts from firms like Maxim and H.C. Wainwright are setting targets as high as $12 to $15. That's a potential 400 to 500% upside from current levels. But here is the so what. Those targets are purely theoretical until the $4 technical ceiling is broken. To justify even the lowest $7 target, Rezolve must hit a $500 million annual recurring revenue run rate. Are we looking at the next AI commerce giant or another cautionary tale? We are officially in the show me phase, and there are 3 specific thresholds you need to watch like a hawk. First, liquidity. We need to see volume return to institutional levels and short interest converge. If dark pool activity stays elevated and shorts remain above 30%, that's a red flag. Second, governance. The February 12th investor call is the deadline for transparency regarding Wagner's divestment status. Will he address the conflict head-on? And third, sustainability. With $19 million in assets against $57 million in liabilities, the cash runway is critical. Any further capital raise below $4 would signal terminal distress. So, what is the final verdict on Rezolve AI? Before I give you my take, I have to remind you, nothing in this video constitutes financial advice. I am not a licensed financial advisor, and this analysis is purely for educational and information purposes only. Always conduct your own research and consult with a qualified financial professional before making any investment decisions. Never invest money you cannot afford to lose. The path is bifurcated. If they navigate the transparency hurdle of the February 12th call and later on breach that $4 resistance level, they could realistically integrate their way toward that $500 million ARR target. The upside potential in that $176 billion market is absolutely real. But the short-term technicals and governance concerns dictate extreme caution. Rezolve AI remains a show-me story. The potential for a massive payday exists, but right now, you are betting on flawless execution in the face of immense financial gravity. Will this acquisition bring the profit everyone's hoping for, or will it be the weight that sinks the ship? Drop your thoughts in the comments. Are you bullish or bearish on RZLV? Smash that like button if you found this deep dive valuable, and subscribe to Smart Stock Sam for more no-nonsense stock analysis. I'll catch you in the next one.